And let's go to the next slide here. So as you may recall, and many of you that have probably already of supply or applied for or received your PPP loans, there's all sorts of strings attached to those items. One thing you want to make sure of at the end of the year is potentially if you haven't applied and received a PPP loan, that you do the calculation that allows you to get the employee retention credit. Obviously, this is something every business should take the opportunity to apply for. Obviously, it saves you money. It's there for a reason. And if you're able to do so, we'd encourage you to make that calculation. Your payroll company generally will be the best person to help you with that. If not, it's a really simple calculation. There's in the notes here, you'll see qualified wages. As you may recall from the CARES Act, that is, those are wages $100,000 or less. They're capped at that $100,000 limit, and the 50% of that qualified wage between that applicable period noted there. Again, just a reminder, if you've received the PPP loan, you actually cannot apply for that credit because since you're applying for forgiveness a separate way. The next one is to calculate and review your FFCRA tax credit. This is another fun opportunity to say, well, payroll company, what happened? Did you do it right, or did you help us through that process? All of us on the payroll company side had to build out software probably within a relatively short period of a month to try to facilitate this entire act that was passed down to us early in the year. As a result, we'd say just nudge your payroll company, have them help you with that FFCR tax credit, and make sure you're taking that as a deduction to your federal obligation at the end of the year. Obviously, that's going to be part of your 941 and 940 filings, but just a double check to make sure that they have your back on those couple items there. The interesting thing, number 3 is one of those items that I love to hate. It's the one that, frankly, if you're not a very sophisticated employee, you potentially are going to get in a worse spot. We didn't see many employees or employers actually offering this to their employees because, frankly, it's deferring a portion of their Fed tax obligation from 2020 into 2021. Yes, I see the ramifications of the benefit for cash, cash poor workers, which is truly unfortunate. However, you're going to have to help facilitate the repayment of those dollars early in 2021 because it's required, as you'll notice from the slide here. The other thing to just be aware of here is the ACA requirements. These obviously are for applicable large employers. Those applicable large employers have certain filings under the Fund Obama Care Plan that we just need to make sure that we're helping you with. If you're available and you have those forms, they're easy to fill out. Typically, you get those from your benefits broker or your benefits provider. Sometimes they're also centralized with your payroll provider. Whoever it is, please double check to make sure that they're planning on doing those filings for you, so you're not left holding the bag if they don't actually do that work for you. I did want to go back, actually, you can go back to number 3. The one thing to just be aware of on the tax credit on the FFCRA, remember that they're subject to limits. Some of the nuanced items inside of that CARES Act was the daily limits of $511 if you have COVID or related symptoms. And then obviously the other one was $200 cap or 2/3 of your daily salary if you have to care for somebody that is subject to that. Again, a lot of nuanced items inside of the CARES Act. That's why we would say at the end of 2020, super important for you to get ahead of this so you're not scrambling at the early part of the year. Now, this is another fun thing that just came out here in maybe the last month or so. This is the change in 1099 treatment, or at least the reporting of 1099s to the IRS at the end of 2020. Interestingly enough, this is the auditor and me coming out a little bit, is you notice on the IRS form, there's a 2021 form, not necessarily the 2020. though you're actually required to use that 1099 NEC form starting on the year ended 2020. So I don't know who's going to call the IRS and recommend that there's a form out there for 2020, but just be aware you are absolutely obligated to file 1099 NECs instead of the old 1099 miscellaneouses for non-employee compensation, which is what we're going to talk about here in a second. A lot of people have said, okay, why the big change? You'll notice here on the form, it's really just making it a whole lot easier. So before, as you recall, you had to make sure classification changes and recommendations based upon where it fell inside of each one of these categories. The IRS has actually done us a lot of help in this one and said, well, if you follow certain criteria, you're actually just going to have to put in one box, which makes it a whole lot easier instead of saying, well, is it other income or is it non-employee compensation? Which one is it? They've just said, hey, let's create a different form. So one thing I actually give kudos to the IRS for there, but just be aware, again, make sure at the end of the 2020 year that whoever you're using for your 1099 plans or filing your 1099s, that they're actually planning on using the appropriate form. If not, states and the IRS are going to kick them back to you, potential late penalties if you don't file them by the January 31 timeframe. Now we'll dive in a little bit about, okay, why the 1099 NEC and who is it applicable to? I would say in most situations, especially ones that we deal with here at Every, this is going to be 90 some odd, almost 100% of all of our payments that go through our platform to contractors will absolutely be presented in that 1099 NEC. You'll notice here, it's really, there is that threshold of $600 or more. Similar items that you'd expect on the old form on putting it in non-employee compensation. So I'm not going to read through all of this, but it's just to give you a good guideline of what should we be considering contractor payments and non-employee compensation versus something else that goes on the 1099 miscellaneous form, which still does exist, is just not as frequently used. Keynote down here, you must also file that NEC for anybody that you withheld federal income tax under backup withholding rules. So just be aware, go through your database or have your payroll company or whoever's doing your 1099 contractor payments, make sure that if there's anybody that elected something other than exempt or elected to have you withhold taxes, all of a sudden you absolutely have to have them in your list of 1099s that will go out as a 1099 NEC. I've also put a whole bunch of exceptions in the appendix to this presentation. There's quite a few of them. They're not super significant, so I would say when in doubt, use the 1099 NEC for most of those compensation payments for your contractors. A couple other items that when I went through and closed years out, what are the things that matter most? And what are the things I can get ahead of to allow me to create or at least go into the new year with some semblance of control instead of trying to put out fires? A lot of that is just a quick review of various things. I don't know when your open enrollment is. I don't know what your policy time periods are. The end of the year is a good time to make sure you have your list of here's all my policies, here's their expiration dates, here's when I need to do my renewals. Do I want to offer a 401k plan? All of the items from an HR perspective is a good place to revisit. You'll notice open enrollment's a very important one. Most companies or a lot of companies use that year-end change as the appropriate time to change coverage amounts. Obviously, it's not necessary to be done at year end. However, if it is, couple notes there. Make sure that you're verifying and double checking your contributions and deductions inside of your insurance broker and validating those into the payroll system. Some payroll systems don't have integrations back and forth between the benefits broker or employee navigator. and the payroll system. If they don't, you have to do a little bit more work. And as a result, please go employee by employee all the way down, top to bottom, and make sure all those deductions are appropriately taken. The second is a very cautious, or a recommendation is on your bill review. I heard this many, many years ago that said, yes, we can trust what happens inside of a billing system, but we always believe in trust and verify. And so we'll also not only trust that the benefits broker is doing exactly what they should do with regards to elections for health and vision and medical, but we also want to make sure on your bill, at least for the first 2 pay periods, that you can understand and realize, for the first 2 months, sorry, that you're actually getting charged for exactly what was elected to by the employees. Just a good double check to make sure you're doing there. A couple other things, the policy configuration. Again, depending on the software you use and the environment that you've created inside of your company, you may want to look at your PTO policy. Is it a rollover plan, or is it a use it or lose it? I think the easy ones nowadays are the use it or lose it, because from an accounting perspective, my perspective, you don't really have much effort at the end of the year. Your payroll liability, your PTO liability goes to 0, and you move on. If you have a rollover plan, just be aware, some payroll systems don't actually auto roll over your PTO values for each employee over to the next year. In that case, you're going to want to take a snapshot of what your PTO balance is by employee at the end of the year, so that you can verify and roll them over into the subsequent period. Again, a pretty manual process, but something that's important. If not, again, you're going to have to go back and recreate this information while they're already accruing PTO in the subsequent year. A bit of a headache. That's why we recommend, if you can plan for it and anticipate it, it's always a better use of time. The other thing is the holidays. Make sure that your holiday plan is configured. We've ran into it a number of times here where you're so focused on 2020 and the year end, making sure that those days are accurate inside of your system, that you miss out on New Year's Day or various holidays early on in the year because you just haven't done something that you should have done. So quick note, make sure you configure your 2021 holiday plan to make sure it's accurate there. And then these last two, I won't go deeply in. It's really just to do a brief audit of your employee records, obviously your employee files, anything that's in there that's significant, to make sure that you have all the appropriate documentation. Not necessarily the funnest thing to do during the holiday season, but necessary to say, okay, great, at least I've closed the year out right, and I'm going to start the new year off at a good foundation and grow from there. And that's our recommendations here from 1 through 10. And I'll pass the time to Ron here.
Yeah, just picking up, Tyler, on that point that you made in bullet number 9. If you do have employees that do want to revisit their W-4 elections and potentially change those or make adjustments to them, just be aware that if for existing employees, it's not required for them to change to the new 2020 W-4. They can stay using the old method. They don't need to make a change. For new employees, they actually do need to be using the new 2020 W-4. And any employees that decide to change their elections or revisit that, they're going to also have to opt into the new 2020 W-4. So the IRS has actually put out a really good tax withholding estimator or calculator. You can find that on their website. I would encourage you that if your employees are wanting to do that, to reference that, either send it to them or spend some time with them and go through it. I think it's a good tool to use. Typical to this time of year, year-end bonuses are also on people's minds. So a few helpful tips here just to keep in mind. If you're paying out any year-end bonuses that are in, money or gift cards, just be aware that the IRS requires that you record those and that they're taxed. So you'll actually have to capture those in your payroll system. If you're paying out a year-end bonus in the form of a gift, say for example, like a ham or something like that, that's actually what we're giving our Every employees. So any employees on this webinar that are Every, I just blew the surprise. Congratulations, that's what you're getting. Joking here, but those are considered de minimis, and you don't need to capture those or tax those or record those in your payroll system. Just be aware of the distinction between the two. The reporting year for W-2 purposes is based off of paid dates. So please keep in mind that if you want to record any year-end bonus or payment that you're making to your employees, if you want to capture that in this year, you'll need to make sure and pay it in this year. It's all based on paid date. So if you're planning on recording it, you'll need to make sure and pay that before December 31st or on December 31st. With some payroll systems, you actually have to plan well in advance to do the work of entering and approving a payment before it actually is paid. So you'll have to factor that time period in. If you look at a calendar, depending on the lag between your approval and when employees actually get paid, you'll have to either be doing that work on the 24th or the 28th. So just keep that in mind and look at a calendar and make sure that you take that into consideration. A little shameless plug for Every and how we do things here. We actually use same-day ACH, and we have a very unique experience where if you approve a payment on any day, as long as it's before our banking cutoff, which is 10 a.m. Mountain Time, employees actually receive their pay that very same day, which is pretty unique. So for our customers, those that are using our payroll software, they actually can be processing payments for year-end bonuses even on December 31st, and everything will be just fine. When you're paying out year-end bonuses, you'll want to look at whether you do that via flat tax or aggregate method. For lower wage earners, the aggregate method ends up at an overall lower tax. You can run some calculations to see what's going to end up best for your employees, but just know that you have a few different options. You can always refer to publication 15. You can just Google that. The IRS has made that available, and there's some examples on publication 15 that you can check. Let's see. Now, if you're changing any pay rates for your employees, just make sure that all of those changes are approved. If there's any need to revisit, the approval methods by your compensation committee or your board, just a general helpful tip there. And then if you're actually doing accrued bonuses, not paying them out in this year, just accruing them, just know that you can actually pay them out up to March 15th of the subsequent year and still deduct those for your company for the current year. Just another tip that you can be aware of. And last of all, and I've run into this in my time as a CFO, communication is key. Whether you're paying out year-end bonuses this year or whether they're performance-based and you're paying them out a little bit later, it's always helpful to communicate well in advance of the actual payment of those bonuses, just so it's very clear for employees and they know what's coming. Oftentimes, if that communication is lacking, that'll end up in disgruntled or confused employees, which is never a good thing. Let's go to the next slide, Tyler.
Sure.
And this is more here for this last slide, I suppose, a bit of a parting note, just something to keep in mind. For many of you on the call, you might be responsible for your overall benefits package and what you're providing to employees, with the overall goals of attracting, engaging, and retaining your employees. There's some trends that we're seeing, really strong trends in the consumer space that we're seeing are translating into the payments world, in particular payroll. And just wanted to make you aware of these. And I'll actually just open up and share a really quick story that happened just this week, like earlier this week. My wife, she decided to purchase Monopoly Deal cards. It's a card game that we've been playing, her and I. It's rather fun. You can get through a game in like 10 and 15 minutes. You know, there's some strategy to it. It's not just all luck, so it's pretty fun. Anyway, she decided she was going to buy some card games for our neighbors as gifts. And we were just, winding down for the evening, and she ended up making that purchase late in the evening. It was roughly 10 p.m. at night. And the very next morning, roughly around 10:30 to 11 a.m., Amazon actually delivered that and dropped it on our doorstep. So if you can just imagine, from roughly 10 p.m. one evening to the very next morning, that complete revolution happened and it was fulfilled, which is pretty phenomenal if you think about it. The whole effort of the convenience of it, the speed of it, the flexibility of being able to do that just from her phone when she made the order. It's pretty phenomenal. And when you consider the other experiences that are in the consumer space, like watching movies on Netflix or Disney Plus, or getting a movie, buying a movie or renting it off of Vudu, some of those experiences, they've all provided an experience for employees where it's just very speedy, convenient, and flexible. And these trends we're also seeing are translated and appreciated by employees in the payment space. And we've recently conducted our third annual worker survey. This is the third year that we've done this. And this is just a little glimpse into what we'll be releasing here in the coming weeks, which will be, more robust information about the results that we saw. But if you look at the metrics here, coming from that survey, both for contractors and employees, you can see that that they both really appreciate getting paid on a much more faster cycle. For contractors, 78% of the respondents weighed very heavily on the top end of the scale, saying that they would be more likely willing to work for an employee that offered that as a benefit. And then when you look at some of the responses from W-2 employees, a pretty significant amount of them responded that they would stay with their company longer, they'd be more dependable, and that they would work more hours if the employer offered that as a benefit. Given the circumstances in the world right now, and more and more employees working remote, this is a benefit and a perk that's actually very valuable, considering some of the perks that are more often seen when you're working in the office, like snack balls and ping pong tables and foosball tables. Those aren't really as relevant now in the backdrop in the economy that we see. Paying your employees faster is one that's very valuable and is well received. And with that, I think we'll wrap it up. Tyler, unless you have any other comments, we can, I suppose, open it up to questions.
Yeah, I'd say we can open up the questions now. Just a reminder of, I would go through that checklist. It's formulated in our presentation as a checklist of sorts to allow you to go through and say, okay, have I done 1 through 11? So please, we'd encourage you to look at those bullet points, and we'll potentially send out this webinar as well to make sure that you have opportunities to go through all those items. With that, back to Kyle, or we can host the questions or concerns if there are any.
We've got a couple here, and if you can see them in the chat, you can read Franz's question there, or I'm happy to read it.
Sure. Let's see if I can see the chat. Now I can see the chat. I'm on a cash basis and I pay monthly. Will the payment on December 31st be able to be deducted in 2020 if the cash is paid in 2021? And how do I change the payment in every to pay a few days early? Yeah. So this is one of the things Ron was mentioning at the end of the year. So what we'll want to do in this situation is you'll want to have the funds actually available and ready for payment on the 21st or the 31st. That's the safest and best approach. As Ron mentioned, it's a cash basis report. And as a result, we can facilitate an early payment on our side. All we would have to do is know what you're intending to do. We can generate your pay run with a flick of a button, so to speak, and you can process that payment, frankly, on the 31st for payment on the 31st as well. So
yeah, Franz, and one other quick point, if you're accrual-based accounting, you can defer the actual payment and still record it as a deduction. If you're cash-based, you'll want to, like Tyler said, make sure that it's paid in this year.
And I think if that's it for the questions, we're more than happy to answer some offline. So reach out to us. Here, you got another one from Ron though. For a payment on the 31st, should we call or do it online?
Yeah, we've made it accessible so you can do it on our app, on your phone or on your computer. It's really easy. Uploading the payments, we've made that so it's super slick where it's just a simple uploading of a spreadsheet. You can get them all, in the system and done within minutes, if not seconds. So we've made that really, really easy to do.
that being said, we're always happy to talk to you, Ron. If you need to call us, no problem at all. We'll wish you a Merry Christmas and a Happy New Year at the same time.
So if there aren't any more questions, again, we'll be sending out this recording. You'll have access to all the slides and the information. And again, we'd love to hear from you. So reach back out if there's anything we can help with, and we'll be in touch, but be on the lookout for this recording. Thanks to everyone that joined.
Yep. Bye-bye.